Bill Ackman, the super investor in charge of Pershing Square Capital, has just made a huge buy, taking a holding he didn't even own 2 quarters ago to his number one holding in a close to $13 billion portfolio. Today we are going to be discussing this company in particular that now makes up over 13% of Bill Ackmans' portfolio, its current valuation, and why Ackman has been buying so much of this particular company recently. And we'll be doing our own valuation towards the end, so please feel free to stick around for that. And as always, if you like this video and the content is providing something for you, then please feel free to give the video a like and maybe consider subscribing to the channel. So Bill Ackman, a very famous super investor that manages a portfolio of about $12.9 billion, has recently, in just a few quarters, bought into 2 very big companies. We're going to be focusing on one today, but we can talk about the other one as well. So, in the most recent quarter, Q3 of 2024, he recently updated his 13F filings, like lots of other super investors. So you'll probably be seeing quite a few super investor related videos. I personally wanted to focus on Bill Ackman because he bought into a position that I'm very bullish on. It's a company that I own in my portfolio, so I think it's only fair that I cover maybe his reasoning why he's buying it right now. So first off, he bought a lot of Nike. Now, he's now got about 11.15% of Nike as his main holding, and that adds about 435% to his already about 2% position. If we look past the ad that's recently just come up and we take a look at his Q2 earnings, he sold a lot of his other portfolio, including Chipotle and percentages of Google. So he trimmed Google and Chipotle and then bought into both Brookfield and Nike. Now, he only nibbled at these initially, both buying about 2% positions. But now, in the most recent quarter, he's trimmed other positions as well, CP and Hilton Worldwide Holdings, which he trimmed quite significantly, I would have said, around 2.8% of his portfolio. And now he's bought into these 2 companies. Now, adding 435% to Nike adds about a 9% portfolio weighting to his position, so makes it about 11% position. And Brookfield Corporation, he had 377% to, and that adds now about a 10.66% change to his portfolio. So it's a significant amount, about 19% of a $12.9 billion dollar portfolio is very big. These are not small changes he's making. Now, when we look at what this might mean for his holdings now, it now means that Brookfield Corporation is his second to largest holding, not his main particular holding. Because even though it's at the top, an individual holding that is the highest and number one, it doesn't necessarily look that way when we look a bit further down, because we've got Google, Alphabet, Class C shares and Class A shares making up the majority of his portfolio still, sitting closer to about 15% of his overall weighting. So it's not a case that he's solely gone into Brookfield. He owns other companies, but he has bought into this one significantly in Q2 and Q3 of this year, along with Nike. Now that means his reported price for Brookfield Corporation now sits at $53 compared to the current share price that sits closer to about $57 or so. So it's quite a good weighting, and it's a company that I'm quite bullish on. So now maybe we can talk about what Brookfield Corporation is, what it does, how it makes money, and maybe what Bill Ackman sees in this particular position that he's made such a big part of his portfolio. Well, this company is a Canadian asset management company. It essentially focuses on building wealth through alternative assets. That is assets that are otherwise not stocks specifically. Although the reality is they make money through that because they have lots of companies that are publicly traded. But when we look about breaking down what Brookfield Asset Management does, it's rather complicated. It's not as simple as a business that produces a product, sells that product and produces free cash flow. It's a lot more complicated to that. They've got lots of businesses that are under the holding company of Brookfield Corporation. So don't worry, we're going to break this down a little bit. In this particular case, we've got 3 sort of separate parts to the main business. Now, first off, we've got their operating businesses. This is the sort of lifeblood of Brookfield Corporation. It makes it integral to what they do and how they operate. So this has about 42 billion in terms of capital, only produces about 1.6 in distributable earnings. That's by managing infrastructure, charging for the use of that infrastructure through lots of different companies. So you've got their property group, BPG, their infrastructure group, their energy group. These are all companies that they've built and then sort of developed. They own hydro dams and wind farms and solar energy. So when we look at what Brookfield does, their operating businesses are essentially backbones of governments and countries that basically keep the infrastructure going. And Brookfield buys into them to make themselves a part of a community, part of an infrastructure, and that much harder to get rid of and not use. They've recently signed a deal with Microsoft in relation to Brookfield Corporation and Microsoft providing energy to them. So this was to provide about 10.5 gigawatts of energy by 2025 and 2026 to Microsoft to run their data centers and a few other things. So that's a massive deal that's netting a lot of cash flow for Brookfield Corporation, and it's the first deal of its kind. And Brookfield has the infrastructure in order to actually deliver on the promises they are agreeing to. So they're among the smallest in terms of providers of that much energy, and it's not just what they do, it's other things that they've got involved in as well. And then we have Brookfield Asset Management, which is traded on the ticker BAM. It's publicly traded, but only a small percentage of it is publicly traded. About 72% is owned by Brookfield Corporation. Now, because they own that much, they have distributable earnings that are provided by BAM. It's a spin-off company that effectively does asset management, essentially. They manage assets on behalf of other people. They keep a percentage of the carried interest or returns that they get from those assets. And they also charge a fee for managing those assets for other companies and providers. That's pretty impressive. It's growing very well. And the actual stock itself has done very well in the public traded markets, which means that Brookfield Corporation's shares are worth that much more. That is their main sort of producer of free cash flow, in my opinion. And if Brookfield Corporation is going to do well, BAM, or Brookfield Asset Management, has to do well as well. And then we've got their Wealth Solutions business, BNT, which is growing very rapidly, and it's their insurance-based business. So we have their operating businesses, which has about on the limited side, about 4 companies, but actually quite a bit more than that. Quite complicated, but it's infrastructure based, it's energy based. Then we have asset management, which is alternative assets other than stocks and shares, and generally it produces the most of Brookfield Corporation's cash flows. And then we have Wealth Solutions, which is growing very fast. They're insurance based business that's doubled its distributable earnings from quarter to quarter, year over year this quarter. So they're doing very well, but we add that all together and we get very good distributable earnings of about 4.8 billion over the trailing 12 months. So that is effectively their free cash flow. Now we're going to keep that metric in mind because that's going to be very important for later on. So Brookfield's philosophy, if you like, is to effectively run businesses very well, or start businesses, run them effectively, and then reallocate free cash flow to other businesses that they own or buy new businesses. So essentially they funnel cash away from businesses that are just maintaining, not growing very fast, like their operating sides of the business, and then they reallocate that free cash flow into businesses where they can maybe compound that cash even more into the future, like their new insurance business. Now, when we look at what Brookfield has managed to do over the past 30 years, they have this very impressive slide here. Now, this was in their Investor Day presentation, and this shows their annualized return over the past 30, 25 and 20 years against amazing companies like Amazon, LVMH, Berkshire Hathaway, Walmart, and the market itself. And what we can see just by this very simple graph is that they've beat over the past 30, 25 and 20 years an annualized return against the S&P 500 and Walmart and Berkshire Hathaway. Now, that's not to say that it's a better company than these ones. It's just to say that it's a different company that has and can evidence the fact that it's outperformed them in share price appreciation over those time periods. That's because they've managed to grow their earnings, capital allocation, and just free cash flow or distributable earnings, which is their main KPI, over that period by massive amounts. I would say this is mainly due to an amazing management team, Bruce Flatt and other things like that. But it is just very impressive when we look at a total compounded return of over 13,000% over the past 30 years. So this is just a slide to show how well Brookfield can execute and the fact that they can evidence that execution in the past. And I think Bill Ackman probably sees this as a very good thing, even if he doesn't completely understand a very complicated business like Brookfield. And just to show how well they can grow their businesses, we first off have BAM, or Brookfield Asset Management. This is their main distributable earnings contributor. It contributes for about half of their distributable earnings or cash flows. And they've managed to scale it up from 0 billion in terms of overall assets that they manage over 25 years ago to today having about 1 trillion, in fact a little bit more than that now. And they've now said that in about 5 years they will grow this assets under management to about 2 trillion. So they're going to execute and continue to perform well in this space, and they think they're going to grow at the number of assets very impressively over the next 5 years in just this one business. Then when we look at their wealth solutions or their insurance-based business that's been growing very rapidly, we see a similar thing. They had about 2 billion in insurance assets 4 years ago. Today they have 110 billion. So that's a massive outperformance of about 5,500% or something like that. And then they said in the next 5 years they will grow that to about 300 billion in insurance assets. And they've also said they will shortly generate about 2 billion of profits annually from just this one business. And this has grown over year in this quarter by about double. So it's really impressive to see how they grow individual businesses. Now, Wealth Solutions is a massive consolation, hasn't been there for that long, but BAM, they've been growing for a long time. So now we know a little bit more about how Brookfield is broken down, what areas of the business are actually the ones that we want to do well with. We can take a look at their free cash flows or distributable earnings, which is essentially what they produce. The main reason that Brookfield doesn't have free cash flow on its balance sheet and is very hard to value is because essentially they have what is called distributable earnings. They reinvest their free cash flow straight away back into other aspects of their business. That means on their balance sheet, their free cash flow looks very bad. It goes up and down. It's never really on the balance sheet to begin with because it is reinvested almost straight away. Now, when we look at trying to value a company, we have to use key performance indicators in this particular case. Their main key performance indicator, in my opinion, is distributable earnings. Now, there are two different types. They're distributable earnings before realizations and capital allocation, and distributable earnings once they've realized gains on their actual free cash flow. And then we have, in this particular case, their growth rate for the next 5 years. And in fact, they can evidence the fact that over the past 5 years, they've met or beat their guidance by 18% CAGR. So, to me, this distributable earnings guidance of 2024-2029 is very significant. If they can beat or even hit this, it's very impressive and shows that the company is going to execute very well. And they've managed to do that 5 years ago. So it's not just some idle boast or guidance that isn't really with merit. It is a guidance that they have thought about, they clearly know their business very well, and have been able to execute 5 years ago with a similar mindset. So that being said, we can try to break down this particular one right here. First off, we have distributable earnings before realizations and capital allocation. In this particular case, we break down the different aspects of their business and how much cash flow or distributable earnings they are producing. We can see here this small little blue bar in 2024 is the operating sides of the business, the infrastructure, the energy-based part of the businesses and their property portfolios. In that particular case, we can see it's not going to grow by massive amounts. It's not making up a massive weighting of the distributable earnings for these parts of the business. They are just sitting there, not growing very much. Now, what we can see is probably what's happening is the free cash flow that these companies are this part of the business is producing is getting channeled into other sides of the business so they can compound it elsewhere. Then we get on to asset management or Brookfield Asset Management. It produces the majority of their distributable earnings or free cash flow right now. And they expect that to grow very quickly as well in the future. But they've also said the main thing that's going to grow, the main thing they're depending on and guiding for is the growth in their wealth solutions or insurance-based business. Now, we know the likes of Warren Buffett and other people have been very good in this space. It's helped them grow their other businesses very well. In this particular case, they think they're going to over triple that amount in the next 5 years by the looks of this graph. They say they're going to grow their distributable earnings at a CAGR of about 17% before any realisations, which is very impressive. Now, where it gets even a bit more complicated, but also very promising for Brookfield, is after realisations, or two particular things: realised carried interest and capital allocation. Now, in this particular case, they say that's likely to grow by about a 25% CAGR over the next 5 years. That's massive amounts of growth, and it's guidance that has been given in the past and maybe be delivered on. But capital allocation and carried interest can vary quite a bit and is not really substantial, so it's quite hard to predict. In this particular case, they believe that it's carried interest that's going to make up the majority of the returns by 2029 compared to their capital allocation, which is almost non-existent right now. So these two things are going to help grow Brookfield Corporation's cash flows into the future. Now, that is very important because when we look at how they value their own stock at the moment, they basically believe it's undervalued right now. So they've got here that their current intrinsic value, according to their metrics, of their shares is currently sitting at $84 per share. And their current share price sits at about $56 to $57. So obviously there's quite a bit of difference there between how they're valuing their own stock and how the market is valuing it. I mainly believe this is because distributable earnings are a KPI that is specific to Brookfield. If it was written on a balance sheet as free cash flow, I believe they would be valued quite a bit differently. But that's not how the business works, and that's not really how Brookfield operates. Now, they say they're going to grow that percentage of their intrinsic value, if they like, by 16% CAGR over the next 5 years to an intrinsic value of $176 per share. Now, when we take this and we compare it to their value for their shares right now, when this valuation was going in, they effectively had a value per share of about $50. Now, the market's actually added a bit more on since then, but we can see the market price of 2024 sitting at $50. They believe their actual planned value and net asset value is sitting closer to about $84. And they say they're going to grow that by 16% in 2029. But if the company starts getting valued differently, if people start to realise what an amazing deal maybe Bill Ackman and other people have invested in, they might choose to start valuing this company for the growth and predictability it can produce. And if that particular case happens, you might get a 29% total return from the valuation of about $50 per share. So they're effectively pricing in and then allowing for even more growth in the future. So I see a lot of upside from this current share price, even now with a run-up in the market. And finally, they have what is effectively a very impressive graph. We can see here that this graph here shows its performance against the S&P 500 its outperformance of the S&P 500 over the last 30 years, which is something I don't think any sort of massive companies have been able to produce other than Berkshire Hathaway and a few others. And then we see the level of return that Brookfield has actually been able to produce. So they say an 18% annualized return over the past 30 years. But simply having the price trade at value brings a return closer to about 20% or over that. So since 1994, Brookfield Corporation has had a NAV that was sat well above the share price. So it should be noted that the market has very rarely, if ever, bought into Brookfield NAV when it has been at its level or its planned value. So very often the market doesn't price in this $84 per share. They usually put a discount to that because maybe it's very hard to understand for people. So then we have what the NAV is now, which is $84 per share, and what is effectively the market price, or $50 or $56 per share right now. So we can see that effectively this company has produced amazing returns, outperforming the S&P 500 over an extended period of time. And they can see that they keep growing their intrinsic value, which is a really big thing. If a company can continue to execute into the future, continue to create value and wealth for its investors, then the share price will continue to follow the fundamentals, which are always getting better. So I think Brookfield is very good at evidencing this, but people are very distrustful of this business being very complicated, which I can appreciate. So I think we actually have a business and a management team that are executing very well. The market has reinforced this by basically annualizing their return at around 18% compared to the market's S&P's 11% over the past 30 years. And I think that the fact that they give achievable and very good guidance is evidenceable in their Investor Day presentations and third quarter reports. They've also got a history of basically developing capital and making it worthwhile for shareholders and opportunity buying back shares. All good things for investors. But now we have to ask ourselves if Brookfield Corporation is trading at a discount relative to its relative value right now, or whether it's not a buy right now. So first, if we perform a bit of maths, we can see that the market cap of Brookfield is around 85 billion and the distributable earnings over the trailing 12 months was around $4.8 billion. That gives us a price to distributable earnings of around 17.7 times for Brookfield right now. So 17.7 years until we achieve what the cash flow is pricing in right now. Now that might sound like a lot, but to me it's not. When we consider the fact that they're growing this distributable earnings amount between 17 to 25%, then we compare that to how bigger companies are actually currently valued, we may have a bit of a clearer picture on the valuation of Brookfield right now. So we've got the likes of Amazon, which is trading at 49 times price to free cash flow, Google, which is trading at 38 times price to free cash flow, and then we've got Apple trading at a 31 times price to free cash flow. So we can see this isn't actually a particularly high price for Brookfield. Now, obviously, that is relative to their growth. They've got to achieve that growth, but also it shows how highly priced the other companies are compared to Brookfield. Now, obviously, this metric is not exactly free cash flow. It's distributable earnings, and people may be distrustful of that. It's not actually written hardcore on the balance sheet. So it's that much more hidden, so I think the market has to actually give a fair margin of safety in relation to that metric being different. But if we take this further and carry out a DCF of Brookfield, we can say that they're going to grow this distributable earnings over the next 5 years via a very bearish result, say 17% per year. Now they say they will buy back around about 1% of shares, which is about right per year for Brookfield Corporation. And then we have to give a price to distributable earnings. Now I put down about 15. I think it's very conservative. It's a discount to what they're trading at currently of about 17.7. But I think that could have some margin contraction really there, and I want to allow for that. Then we get a fair value of around about $63 per share. and still get a market beating return on that CAGR right there. If we then up this growth to 25%, which effectively the company has also offered as its best case scenario with carried interest and capital allocation, we can see then the CAGR over 20% for annualized return. So every year around 20% return in capital appreciation and a fair value of over $100 per share, which is obviously massively impressive. So now we can go in the middle. We've done the best outcome, we've done the worst outcome. Both have now seemed fairly attractive according to this share price of $56 to $57. But if we do a middle assessment, we get a fair value of 21% growth in free cash flow or distributable earnings. Then we get a fair value of $75 per share and a CAGR over the next 5 years of around 16%. Now, to me, this is massive and it is an opportunity which I have been adding to in my current portfolio. Before their earnings, I bought around £2,000 more, trimming my shares in CRM to do so. And it now accounts for over 16% of my portfolio and will likely become a bigger part of my portfolio if this price and market continues to value Brookfield the way it is, because I see value here. So to me, I think Mr. Ackman sees that this is a good price to buy Brookfield relative to its predictable growth that they can evidence. But it's a complicated business that not everyone is comfortable giving a higher weighting in their portfolio to, or even owning at all, which I can understand. But what do you guys think? Do you like this business? Do you see this as a good buy for Bill Ackman and his portfolio? Let me know down below. And as always, thanks for watching. I do appreciate it, and I'll catch you in the next one.